Most Western governments are basically bankrupt. And I think as confidence in the governments gets less and less, you're going to see more and more people are going to diversify some of their wealth into metals, something that they can hold in their hand. My big picture view, I'm on record saying this multiple times, but $100 silver I think is going to be a piece of cake. Now, when I say a piece of cake, it doesn't mean it's going to go there tomorrow. It doesn't mean it's going to be an easy move to get there. It'll be difficult if you're trying to trade it, but I'm saying it's going to get there. And for gold, $5,000 is going to be a piece of cake, and $10,000 isn't out of the question. And I think $250 to maybe even $500 silver isn't out of the question either.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today's guest is Gary Savage, the president of the Smart Money Tracker. It's a daily market newsletter available online by subscription only. The Smart Money Tracker provides in-depth commentary and charting analysis of the stock, precious metals, oil, and currency markets. Recently, Gary said, there comes a time when anything just gets too cheap to ignore, unless you're convinced that the sector is going bankrupt. And I doubt miners are going bankrupt with gold over 2,000. So today, we're going to go in depth on gold and gold miners with Gary to find out exactly where his analysis is showing him where the yellow metal and miners are going. We'll also touch on silver, oil, and the markets if we've got the time. Get ready to enjoy a fantastic discussion with Gary Savage. Gary, thank you so much for joining me today.
Thanks for the invite, Gary.
So, Gary, what is your 10,000-foot macro take on the current role and need for gold, and what you see happening with the precious metal in 24 and 25?
So I think we're in a period probably where the West is in decline, and as governments, most Western governments are basically bankrupt. And I think as confidence in the governments gets less and less, you're going to see more and more people are going to diversify some of their wealth into metals, something that they can hold in their hand. My big picture view, I'm on record saying this multiple times, but $100 silver I think is going to be a piece of cake. Now, when I say a piece of cake, it doesn't mean it's going to go there tomorrow. It doesn't mean it's going to be an easy move to get there. It'll be difficult if you're trying to trade it, but I'm saying it's going to get there. And for gold, $5,000 is going to be a piece of cake, and $10,000 isn't out of the question. And I think $250 to maybe even $500 silver isn't out of the question either.
Interesting. So, we've seen through the years that gold and the US dollar sometimes are highly correlated together, and at other times they're decoupled. In your analysis, how correlated together are the dollar and gold currently, and what are you seeing for the dollar throughout 2024 and into 25?
So I don't really think that the dollar controls gold, but it does make it easier for the banking cartel, the bullion banks, to suppress gold. If the dollar's rising, it's just easier to keep gold suppressed, and they, the Fed is in theory trying to fight inflation right now, so they want to suppress gold. You can't claim to be fighting inflation and have gold at $3,000 or $4,000 or $5,000. So they're trying to keep the price suppressed. They're going to fail, and there will come a time where gold, and there has been times in the past where gold just ignores the dollar. It can go up along with the dollar, and that will happen again. There'll come a time here. I think gold probably has to break out above 2,100 first, but once it does, I think it will start to just ignore what the dollar does.
Interesting. So in your analysis, what outside forces, I heard you talking a little bit about that just now, are suppressing gold and preventing it from crossing over the 2,100 mark? And do you see those forces having the ability to suppress the price indefinitely?
No, well, obviously they can't, because gold has gone from $250 to $2,000. So they can slow down the rise, which they have done, but they can't suppress it permanently. I am pretty confident that gold is going to break out of above that 2100 range. And I'm not talking a breakout in the middle of the night that then gets, uh, you get a wave of selling in the middle of the night to break or to stop that breakout that we had in December. I'm not talking something like that. I think we're going to get a breakout above that that holds and then produces a sustained move. It'll pretty sure it'll happen this year. I think it's going to happen during this next intermediate cycle.
Are you there?
Pretty mild. It's mostly just gone sideways. Hasn't really done much damage to price.
So, did you mention the forces that you believe are suppressing gold at this point?
Well, I think it's probably just the bullion banks. Like I said, the Fed is trying to, in theory, fight inflation, and you just can't have metals. You can't have gold at $2,000 or $3,000 and claim that you're having any success at fighting inflation. So they, we've all seen this, and we saw it. It was pretty glaringly obvious on that December. I don't remember the exact date. Um, Gold shot above 2100 in the middle of the night, but then almost immediately the market was flooded with sell contracts, and they had it back below the. I think the actual breakout number was 20,090. They had it back below that before the market opened, and um, I think they had it back down to about 2088 before the market even opened, and that turned out that was the inner or the top of that intermediate cycle.
So, admittedly, you've been very good at calling tops and bottoms in gold, and in your analysis, you've been talking here so far about that you do believe they're not going to be able to suppress it further. Gold is going to break out, and you do see it happening soon. How far away is gold from bottoming and flipping bullish? And do you see it becoming the trade for 2024? Or do you think maybe because of the election, they're going to work overtime to keep it in check, and then maybe it'll happen in 25?
I think it's going to happen this year. We've got about 10 trillion in sovereign debt that has to be rolled over this year. It's going to be a problem. Interest rates are higher. Looks to me like the bond market is rolled over again. So interest rates are going to be going up as they're trying to roll that debt. So I think the problem is going to occur this year. I think gold's going to break out above 2100 during this next intermediate cycle. I'm a bit up in the air right now. I'll go into this a little bit here, but I'm saving the more detailed analysis for my subscribers. But it's possible that gold may be trying to complete that intermediate cycle low right now. There's a few things I'm looking at that would, a few things that have to happen before I could say for sure that, yep, that was the bottom that we got last week. It may also be that this is just another bounce that rallies for a few more days, maybe even 5 to 8 more days, and then rolls over and comes back down again and has to break that 2000 level. There's lots of stops below 2000. So if the banks can run gold below 2000, they could trigger a lot of those stops, and then we'd get more of a washout than what we've had so far. Now, we've had, a plenty large enough washout in the miners and silver for this to be a final intermediate bottom, but we haven't done much damage in gold. So I'd say if I had to put a percentage on it, I'd say the odds are probably 60% that we're going to get a bounce that then has to roll over, and they break that 2000. We get our washout, and that's our final bottom. But there is a possibility that maybe we put in that bottom next week. I'm just, like I said, there's a few things I'm waiting to see, and if they happen, then I'll make that call.
So sentiment clearly plays a huge role in the purchasing of any asset class, and specifically gold. Sentiment can lead to extreme greed, which can create asset bubbles, or extreme fear, which can create the foundation for a massive bull market. Gary, sentiment for gold and miners seems really poor over the last few years. Can you explain to us the role sentiment plays, where the sentiment for gold and the miners is currently, and what you see coming that's going to flip sentiment bullishly towards gold and the miners?
So sentiment in miners and silver is very depressed. Gold is pretty much neutral because, like I said, it hasn't really done much damage. The current intermediate decline has mostly gone sideways, and that was kind of my expectation when this started, was that this intermediate decline, they can unfold in one of two ways. They can either have a deep regression, sharp pullback that creates extreme bearish sentiment, or you can just go sideways for a long time until people get frustrated and give up. And that's kind of what the metals have been more or less doing since that top in 2020. They've just gone sideways, and if you read the tweets and the comments, people are just frustrated. They're giving up. Silver's never going to go anywhere. The miners are, I'll never buy miners again. So we're getting that sentiment, that frustration sentiment that's what these sideways churning corrections produce. They produce frustration. The big scary pullbacks, the sharp sell-offs, those produce fear, and either one of those can power another big move. You can either get extreme frustration or extreme fear. I think we're mostly getting extreme frustration.
Yeah. I've seen some of the same tweets. I'd have to agree. When it comes to buying household and personal goods and items, we consistently look for the item to go on sale, or we scour the web to find the cheapest price. But when it comes to stocks and other assets, we seem to struggle to buy when the price of the asset has dropped, and drops substantially. We want to see it going up, and away. It's kind of a mindset that we have. However, because of that mindset, we lose out on the big gains by not buying at the bottom or when it's truly on sale. Warren Buffett says we need to be fearful when others are greedy, and greedy when others are fearful. Baron Rothschild said, buy when there's blood in the streets. In your analysis, why do people have such a hard time buying and selling assets the way Buffett and Rothschild recommend? And when it comes to gold and gold assets, do you currently see blood in the streets, or are we getting close?
We're getting close to blood in the streets, especially in the mining sector. I'm going to let your subscribers or viewers here in on a secret. The way to buy low in the metal sector is to buy physical. The reason people can't buy low and sell high is because you don't know where the exact bottom is. And if something's going down, you're already scared. And if you buy, and if it's not done going down, then what happens is you panic, you sell again. And then maybe you try and buy again. If that's not the bottom, you panic again. And then at some point you're shell shocked and you can't buy anymore because you've lost money on your first two attempts to call the bottom. You can completely fix that problem by buying physical. And part of the problem is every day you log in, and first thing you do is you look at your account value, when you're buying ETFs or shares or something, and you see it's down. But nobody goes to their calculator first thing in the morning and starts calculating how much their physical silver or gold bars are worth every morning to see how much they're up or down. They're there. You can hold them, and they look pretty. And so that is the secret to being able to buy low. It's a great advantage that metal traders have, that like stock traders and stuff and people that are trading paper assets don't have. You can buy physical gold and silver, and if you don't get the exact bottom, you won't panic. You'll still have your silver or gold bars or coins, and you'll be able to buy again if it goes a little lower, and you'll be able to hold. And more importantly, you won't overtrade the bull market, and you won't sell too soon when we get into the bubble phase. Whereas if you've bought shares, then, and especially if you missed the bottom, you took a big drawdown, now you're nervous. Now your mindset is, I need to get back to even. And so you were buying with the intention of holding for maybe an intermediate run, but because you took a drawdown, your mindset has changed, and now you just want to get back to even. And so you sell, and then you miss a huge move, which is what you were trying to catch to begin with, because you couldn't time the exact bottom perfectly. But you can cure all of that by just buying physical gold and silver.
So I did hear you say at the very, very beginning of that answer that you do think we're getting close to seeing blood in the streets, though. Is that right?
We're definitely seeing blood in the streets in the mining sector. And I would say it's starting to bleed in silver as well. I looked at the gold silver ratio for miners, like the HUI to gold, and we're almost at the same ratio we were at the bear market bottom in 2015. So we're seeing blood in the streets in the mining sector. So generally, I don't like to buy miners. It's just kind of a crappy business. But like when you opened up the show, there comes a point where anything is just too cheap, and we are at that point, or very close to that point in the miners, where they're just too cheap. So I'm going to be buying some. Well, I don't buy individual stocks. I don't like company specific risk, but I will be buying some mining ETFs, some GDX or GDXJ, if I think, or when I think the intermediate bottom has arrived.
Yeah. So since 2011, and you've kind of touched on this a little bit, that there's been a few bull runs for gold: 2015 to 2016, 2019 to 20, and 22 to 23. Each one had a little bit of a bull run, different sizes. The 2019 to 2020 run was the biggest of those, and that was around 40%. The last really big gold bull market ran from 2000 to 2011. That one ran up almost 800%. Do you see a gold bull market forming that will be comparable to the most recent ones mentioned, maybe up to 40%? Or do you think there's one coming that's more similar to the early 2000s, or maybe somewhere in between?
Early 2000s. The rule is the bigger the base, the higher in space. I'm sure most people have heard that. Let me show you a chart here. I'll go over to gold. And this is one of the reasons why I think that silver is going to go as high as I think it is going to go, to at least $100, and probably a lot higher than that. So again, the bigger the base, the higher in space. Here was our top. We've had a few pokes above it, but none of it really sustained. So I would view this as a base that started in 2011 and still hasn't really broken out, and we're in 2024. So this is about a 13-year base. And generally speaking, the run, once the breakout occurs, will be about the same magnitude. So, for a 2000 now, and we assume that, this huge base here is going to produce another move. If I had a way to extend this chart upwards, this suggests to me that, 5,000's only, 150%? That's nothing for a base that's 11, 12 years, 13 years long. That's nothing. So that's what suggests to me that 10,000 is very possible in gold. Is the size of this base. And if you think that base is big, silver is 43 years and counting still. And so, and the way, and I'll put silver up here, and this is kind of what happens with silver. It can languish and churn and not do much, and then all of a sudden at the very end it takes off. And so here's a really good example as we went into that bull market top in 2011. Slowly moving higher, and then we get a breakdown, but in a breakdown that broke below support here, made everybody think that silver was dead. It recovers, and then in the final, whatever this was, 6 months to a year, we get this parabolic move. Same thing here. These parabolic moves towards the end of the intermediate cycles or the end of bull markets. So I'm going to guess in sometime in 24 here, I think we're definitely going to test the top of this consolidation here at $30. I think we'll test that. I think there's a decent chance we could break out and maybe test this 35, $40 range here this year. And maybe by sometime in 25, we could get up here and test 50. And then once we get a breakout from 50, I'm kind of leaning more towards this bull market lasting into 27 or 28 rather than occurring really rapidly. So I'm going to guess once we get to 50 and get a breakout, silver will probably take the better part of 2 years maybe to get from 50 to 100. That might be a slow process. But then in the final parabolic phase of the bull market, the bubble phase, so to speak, silver could go from 100 to 500 literally in the last 8 to 12 weeks of the bull market. It can do one of these type things. And again, if you're in physical, I think you can hang on and catch most of that. Whereas if you're trading shares in your portfolio, you're getting nervous and you're over trading, you're taking profits, and then when it doesn't go down, you get back in at a higher level and you're nervous again, you take profits too quick. So the physical will cure you of that, and I think you'll be able to hang on for most of the parabolic phase of the bull market. And then at some point, because parabolic bubble phases, they all collapse. So at some point you have to control greed and you have to sell a little early. You're not going to get the top, but you don't want to get caught at the top. So you're going to have to sell a little early. And the government may put a windfall profit tax on this. So another reason I think you're going to want to sell a little bit early.
Interesting. So there's two questions I have there. Where do you see the gold silver ratio in this setup that your analysis is pointing you to? And second is, I've heard a lot of people say that, $5,000 or $10,000 gold, we don't want to live in that world. What kind of world are you seeing if we have $5,000 or $10,000 gold?
So to answer your first question, it was 30 to 1 right here at this peak. I think we'll go at least back to 30 to 1. So if gold was to go to 10,000, that'd be about 330,000 silver.
330, yeah.
Yeah, 330. Might go lower than that. Could go to 20. I think historic average is about 15 or 20 to 1. So we might go back down to that level, which could give us our $500 silver. What was the second part of your question?
Just that I've heard several analysts say that a $5,000 to $10,000 gold.
So yes and no. I think I think initially, like the inflation or mistrust in government will start the final phase of gold, but just because gold, let's say, maybe gets to $10,000, that doesn't necessarily mean that the world is ending or that it's costing you $150 for a loaf of bread. Bubbles aren't. Well, they aren't. They're not driven by fundamentals. Now, the initial part of the move can be driven by fundamentals, but the parabolic phase is driven by human emotions. So, if people just see gold go from 2,000 to 5,000 and 6,000, and then you get the average Tom, Dick, and Jane are seeing their neighbors getting rich by buying gold and silver, and they want to get rich too, so they start buying. And so you could maybe get to $4,000 or even $5,000 gold on fundamentals, but then you get to $10,000 gold on human emotions. So I don't necessarily think that the top of the parabolic, at the end of the bull market, I don't know that it would be so much driven by fundamentals and that the world is ending. I think it's probably just driven by human emotions, and that's the point at where you have to control your emotions and realize that this isn't the end of the world, that this is an emotional move driven by greed, and you need to control greed and sell. And then at that point, you need to look for something that's cheap, which will probably be stocks.
So, yeah. And so from a fundamental story, are you looking at a resurgence of inflation that's going to, be the primary driver? What do you suggest will be the primary driver?
So let me put the CRB up here. So the CRB has a 3-year cycle. I guess we could also discuss the multi-year cycle in gold when we get done here. But this was the top of the last bull market in commodities. That was when oil went to $147, I think, and clearly a parabolic bubble type move, and you get the collapse, and then we start this multi-year secular bear market, which bottomed right here, and that was when oil went to minus, I think it was $35. They were, you were getting paid to take oil from people because they had no place to store it. That was the bell ringing that the bull market in commodities was over. You had the first leg up right here of the bull market, and now we're in a corrective phase. This is what I call it's a 3-year cycle low, but the inflationary phase that began is not over yet. I think we're about done with this 3-year cycle low, and we're about ready to start the second leg of the inflationary bull market that we're in. We're in a secular bull market for inflation, so I think commodities are about to start their next leg up.
Interesting. Okay, so that's your catalyst. All right, so recently it was reported that more than 80% of the population owns zero gold. Yet last year in an interview, Ray Dalio, founder of the largest hedge fund, Bridgewater Associates, he said that everyone, including pension funds, should have a 10 to 15% gold overlay on portfolios. Gary, in your analysis, why is the overwhelming majority of the population so woefully underinvested in gold? What happens to the price? Well, I'm guessing what happens to the price and availability of gold if the conditions on the ground are such that hedge funds, pension funds, and individuals all decide it's time to have that 10 to 15% overlay. And do you agree with Ray's 10 to 15% allocation on the portfolio for the generalist investor?
Well, in my opinion, I'd have a lot more than that. But I like to buy things that are out of favor. And that's the reason why most people aren't interested in gold. Now, they were interested in gold back here when gold made that first run to $1,900, because it had been a multi-year bull market. And finally, towards the end there, people were noticing that you can make a lot of money in gold and silver, and that's what it takes to bring the public in. Is something has to go up long enough and far enough for the public to take interest, and then they start buying towards the end of a market, like they were buying Bitcoin in whatever it was, 21 or 2. It had gone up, and I had friends that I rock climb with, that know nothing at all about markets. We're buying Bitcoin. That's the bell ringing that it's mature. Probably if you own Bitcoin, you probably want to sell it to your friends at that point. Same thing is kind of happening with stocks now. It's been going up for a long time. We've recovered that big sell-off. So people are, it's just, in their opinion, it's easy money in the stock markets. I guess we can discuss this later as well, but stocks are getting a bit dangerous, in my opinion, stretched too far above the long-term means. I don't like things that get stretched too far above the mean, because they're at risk of a regression event, and if they get a parabolic move, then they're at risk of a crash. But that's why the average person, gold and silver haven't done anything for a long time, so their neighbors aren't getting rich buying gold and silver, so they're just not interested. They can make money in stocks right now, and so that's where they're at. And there's still a lot of people still trying to play the Bitcoin markets, of course. When you get that bubble mentality that we had in 21 or at that top in Bitcoin, it takes a long time for that to be washed out. So, there's definitely opportunity to play rallies in Bitcoin. It's volatile, so you can get big percentage moves, but you can get them in both directions, up and down. Recently, the Bitcoin miners, they had a nice rally. Everybody got really bullish. Of course, they got bullish right at the top, and then Bitcoin had a minor correction, but the Bitcoin miners, most of them dropped between 40 and 60% over a couple of weeks or two, and that's just so volatile you can't hang on, so you end up losing a lot of money.
So yeah, it sounds to me though that you do see a reversion to the mean in terms of gold ownership for people, but it's just going to take a while, and most of them are going to get in later in the cycle.
Yeah, gold's going to have to go up. It's going to have to break out above 2,100. It's going to have to get some media headlines, and people are going to have to start making money buying gold and silver, and then other people see them making money and they want to make money, and that usually happens towards the very end of a secular bull market. Right now, it's just smart money that's buying low. People that like to buy bargains, and again, I urge people to buy physical. That'll cure the problem of, if you don't time this perfect, or if it doesn't really start to move aggressively off the bat. As long as you're buying physical, you won't have any trouble holding and making it all the way to the end of the bull market.
Yeah. Yeah. So the markets are near all-time highs. You've touched on that, and they're in dangerous territory. They haven't really pulled back much at all. The street was predicting 6 rate cuts this year, with the first to begin in March. And now with the higher inflation readings we saw last week, that seems to have been pushed back to at least summertime. And now the street is saying they only expect maybe 3 rate cuts in 24 at most. Well, it was also recently disclosed that famed billionaire investor Stanley Druckenmiller, one of the greatest investors of all time, he's bought a bunch of Barrick Gold and Newmont Gold stock. What does the Druckenmiller gold stock purchases indicate to you? And if you're trying to think like him, do you view his gold stock purchases as more of a swing play on an undervalued asset, or do you believe he's buying because his belief is that there's a soon to be unleashed gold bull market?
I think he probably sees the same thing I see, is gold is consolidating under that 2,100. When it breaks out, we'll get a breakout from more or less an 11-year base, and it's going to go a long ways after that. So he's getting positioned. The same thing I'm trying to get my subscribers to do: keep stacking your physical metal. Now, any purchase of silver under $30 is a gift, and you missed the gift on gold a long time ago, but still, I think anything under 2,100 is an opportunity, because we are going to break out above 2,100, and once we do, the next leg of the bull market will get started, and you'll be very happy that you bought as much gold as you could under 2,100.
So speaking of the markets that we were talking about there, when a bull market in paper assets ends, liquidity typically moves into undervalued stocks. You can see a classic example of this when the tech bubble burst in 2000. Gary, do you believe that the S&P 500 and NASDAQ are coming to an end of their respective bull markets? And does your analysis point to a rotation of a percentage of those dollars happening? If so, where do you see that rotation occurring, and what is your timeline?
So, yes, I do see the bull market in stocks coming to an end here. And again, I think somewhere I mentioned that we've got about 10 trillion in sovereign debt that has to be rolled over this year and next year. That's probably going to be a huge, that may be the top in the stock market when that happens. And interest rates appear to be going back up again. So they're going to have to roll that over into higher interest rates. And the rotation out of stocks and into commodities has already started. It started back here in 2020. So the bull market in commodities ended in 2020. And kind of the same thing happened back in 2000. Liquidity started to rotate out of stocks as we were getting that parabolic bubble in the NASDAQ. Smart money could see that this was dangerous. They could see it was a bubble. At some point it's going to burst. And the markets are overvalued, and so smart money starts to rotate into undervalued assets, which was commodities. And again, we're seeing the same thing again. Some of the liquidity is starting to move into commodities. It started in 2020. We're getting the first correction in commodities right now, but that's probably just about over, and we're going to start the next leg up here in the CRB, and I think gold will also break out above 2,100 during this period.
Okay, so you recently wrote that the Fed is going to have trouble keeping the market propped up, as they already are starting to lose the banks, that the regional bank index is now making lower lows and lower highs, that's an indication that it's starting an intermediate degree decline. You further stated it's clear that the Fed is trying to keep the market levitated. The Fed is creating the conditions for a crash by not allowing the market to correct naturally. So in your analysis, what are your targets for the S&P 500 and NASDAQ when this decline occurs? And what happens to gold and the miners if either the markets begin to wobble or even if they crash?
Sometimes, well, the stock market is due for a 4-year cycle low. Again, I suspect it's going to occur sometime this year when we start having troubles rolling that debt over. I'll pull up a chart here of the S&P. All right. Let me see if I can put the 200-week moving average in here. All right, so here are the 4-year cycle lows. Here was obviously one in 2020 when we had the recession. We had one in 2016, 2012, and then the bear market bottom in 2009. So you could make a weak case that maybe this was the 4-year cycle low, but it came too early, so I don't think it is. I think we're going to have it here, and we're setting the stage for it. So when you get an almost vertical move like we've had here, and this was powered by the Fed flooding the markets with liquidity to save the banking sector, and that liquidity's got to land on something. Some of it's landing in commodities, but you can see a lot of it is just landing in the stock market, and it is producing this vertical, almost parabolic rally, and that's probably not a beginning move. That's probably an ending move. And the further it stretches above this 200-week moving average, the more nervous I tend to get. All markets regress to the mean. You can see what happened when we got this big stretch here. I think we were on the verge of transitioning into a final bubble parabolic move right here, but the Fed started raising rates just in the nick of time, and they kind of short-circuited that, but then that created the banking crisis. They had to flood the market with more liquidity, and so now here we go again. And so I think it kind of depends. Well, a 4-year cycle low, they almost, as you can see, they almost always at least test the 200-week moving average. So I think we've got at least back down to here. And the further a market stretches above the mean, usually it goes a proportional distance below. So we could go a long ways below that 200-week moving average, and we've got to break this 4-year cycle trend line. So it has to go at least below there, probably has to test that 200-week moving average. In my opinion is that we're probably going to break the October 22 lows. I don't think, because this cycle is right translated, and all that means is it's rallied for more than 2 years. The cycle generally is 4 years long. So if it rallies more than 2 years, that's right translated, has less time to move into that 4-year cycle low. Whereas if it is left translated, then it has a long time to move into the 4-year cycle low, and usually it'll make a lower low. If we had not been able to break above this peak and rolled over, then I would have said that the odds favor going below the 2020 low, but we have. So I don't think we're going to go below the 2020 low, but I suspect we're probably going to go below the October 22 low when this happens. It's not. I don't think it's going to happen during this intermediate cycle, but I think it's going to happen probably in the fall of this year. Now, that may completely ignore commodities. Sometimes that happens. Sometimes the selling pressure is so intense it infects everything. You get margin calls, everything goes down. That's kind of what happened here, but it didn't affect gold all that much. It affected oil really, really bad, but didn't really affect gold that much. Kind of think the same thing's going to happen. We may have some selling in the metals, and maybe some in the commodity sector. But if the war in the Middle East and the Ukraine is escalating, may not get too much selling pressure in the commodities, so they may kind of ignore the sell-off in the stock market.